Well, last time I was here 6 months ago in May, I was talking about, we made this extremely significant bottom in January, just how oversold the gold stock sector was, just in any way you looked at it relative to the price of gold, relative to stocks, and just the bear market itself, the rolling 5-year performance, the rolling 10-year performance. And looking at that, I spotted so many similarities with the bottom that the stock market made in 1942, which turned out to be the greatest buying opportunity of all time for the stock market, because performance after that point, whether you looked at 1 year, 2 years, 5 years, 7 years, 10 years, 15 years, performance from that point forward was really exceptional. And now I didn't discover this in January. It was a couple months later when I figured it out. But what's happened in the last week? There's been a lot of technical damage. So the next couple weeks are going to be very important. And potentially, I'll talk about it in my talk, but if gold loses 1,200, it's probably going to do a round trip and maybe set up a massive double bottom that could happen sometime next year. So we have to be aware of that possibility. And so that's, and if that happens, we'll kind of get a second greatest buying opportunity, a second chance. So first I'm going to talk a little bit about the economic setup. Obviously Trump is the new president-elect, and the Republican Congress, that's an important thing. So they're going to be, obviously infrastructure spending, they were talking about $1 trillion worth of infrastructure spending. We know that tax cuts are probably going to be coming. And so if you were here yesterday and you saw the panel at the end of the day, I was talking about how now we're going to see money actually moving into the economy, via deficit spending, infrastructure spending, probably tax rebates, and the Fed is going to be less important as policymakers look to do those types of things where the money's going to get into the economy and into the hands of people directly, and that's going to be more inflationary. And inflation is already picking up. Looking at this chart, you have various CPIs and PCEs, all these various inflation indicators. You have the sticky CPI, the median CPI, the core PCE. The regular CPI is about where the core PCE is in white. I'm colorblind, so I'm not going to talk too much about each individual line, but we can all see that inflation is obviously, statistically, it's picking up. It's been rising for a little while, and it's not so much what level inflation is at, but it's really the trend and the direction. Is it going up? Is it going down? Because some people yesterday, they were talking to me about shadow stats, and I looked at it this morning, and shadow stats basically has the same trend as the government inflation indicators, but it's plus 3 or 4%. So there's not, the important thing is the trend, the direction more so than the level. And as we can see from these charts, the trend is obviously rising, and this is without commodity prices doing anything. So commodity prices are really the key, and specifically energy prices. If we start to see commodity prices rise again, in the next couple of quarters, and that sustains itself, then we're going to see inflation 3, 4, 5% in the next year or two. And this next chart, we're looking at real market-based indicators of inflation. And the first couple there, they revolve around the bond market. So the bond market is already sniffing out inflation as far as the yield curve starting to rise. TIP versus TLT, you're looking at the inflation-protected bond against just the regular bond. And so that's a great inflation indicator. And you can see that's broken its downtrend. That's above the 400-day moving average. If you follow my work, I like to use the 400-day moving average or the 80-week or 20-month. In everything that I've looked at, that's a more significant moving average than the 200-day, which most people use. And you go to the bottom, we can see silver's outperforming gold. It'll remain to be seen if that can hold above gold in the next month or two. And oil and commodities, they're kind of wrestling with the moving average. So they haven't quite broken above it. They might go down before they go a lot higher. This is my fundamental chart looking at gold and real interest rates, because this is the primary driver of gold. No indicator is perfect, but in the history that I've studied, real interest rates, and specifically declining real interest rates or negative real interest rates, that's really what drives gold higher. And you can see that in this chart. I've highlighted the bad bear markets here, and you can see that during those periods, real interest rates were rising, and even the 2011 to 2015, remember, it's really the direction of where something is moving. So even though real interest rates, they only got to zero or slightly above it, they came from minus 4%. So real interest rates went from minus 4% to zero. So that kind of move is negative for gold because the market focuses on the direction and the change of things and not the absolute levels. And we could be getting into a situation in the next couple of years where, and again, I talked about this yesterday on the panel, where interest rates are rising, but gold also rises. And the reason that would happen is because inflation rises faster than interest rates and faster than the Fed funds rate. In other words, the Fed, they'll stay behind the curve, and they don't hike interest rates fast enough to combat inflation. And in this chart, I have the real Fed funds rate there in the middle, gold at the top. At the bottom, that's the Fed funds rate. So I've highlighted several periods where gold was rising while the Fed was hiking interest rates. Now, they're in the late 1940s. Gold was more or less, it was basically fixed. But in the late 1940s, commodities had a huge move from about 1947 to 1951. So that's why I highlighted that. And you can see during that period, the Fed was hiking rates a little bit. So this is something that I think we could see this play out again in the next couple of years. Now let's get to the technical setup, which, the technical damage in the last week has really been severe. So I'm going to talk about that. And potentially, if gold loses 1,200 and we do break lower, we could probably set up, I shouldn't say probably, but potentially set up a massive double bottom where after that next low, sometime early or middle of next year, then you get a huge move higher because the fundamentals of negative real interest rates are still intact. I don't expect them to change much, but the charts are what they are, and charts and technicals, they lead fundamentals. So I'm not sure, maybe the dollar has a massive breakout above 100, and that creates some selling over the next couple months. Now, looking at the gold stocks, all the things I'm looking at right now, they're all saying that we really need to hold where we are right now for the move that we've had to continue. And looking at, so we have GDX and GDXJ, and you see that both, I showed the 80-week moving average in blue. And if you go back 4 or 5 years, you can see that the 80-week moving average, 2 or 3 times the market rallied up to it, then failed. You can see in summer 2014 it failed there. Now the moving average is rising, which is a good sign. But the miners, let's see if they can hold that moving average, and also those horizontal blue lines. And just that last the last week, that last candlestick, that's just nasty. That's really bad. That doesn't inspire a lot of confidence. And so in the next couple weeks, we need to see a rally, and we need to see it hold going into the next month. And in this chart, I plot, if you follow my work, you know that I do a lot of analogs. And so I'm comparing the correction that we've had to similar points in bull markets, 2001, 2002, and 2006. And these corrections, they basically took an ABC format where you have one leg down, the next leg goes up, another leg down, and the correction's over. The one in 2002, it had another down leg before it ended. But you can see where we are right now in black. That's gone a little bit below where, not too far below, maybe a little bit below where we should be, and it just looks like it's off course. And so, that if it doesn't get back on course with this rebound, that's likely in the next week or two, that's just going to be a bad sign that we're not in a period that's similar to those other periods. And this is a bull analog comparing the bull markets and gold stocks, the one that started in 2000, the one that started in 2008, and right now, again, we're in black, and it's a similar setup where the black line right now is, as you can see, I mean, it's close to the blue line, and if it goes a lot more below the blue line, then you have to question, are we really still in a bull market in this move that started in early 2016, January. This is a chart of, obviously, as you can see, gold against the long bond and also gold against the US dollar. And one thing I like to do with gold is I like to see how it's performing against all other markets. How is it performing against the stock market? How's it performing against foreign currencies? And I haven't looked at these ratios that much in my work just because gold and bonds have kind of been correlated. They've kind of been going in the same direction. And these two, more so gold against bonds, that's the most important chart here, but gold against the dollar is also important. And the reason is because, I mean, we know that we're going to be in a higher inflation environment, but the market right now is focused on rising rates. So they're selling off bonds and they're selling off gold with it. And so the question is, how do we know when the market is going to realize that inflation's going to go higher, rates are also going higher, but rates are not going to go up fast enough, and real rates are going to remain negative. They're going to go even more negative. I mean, what's a way where we can sense that the market has figured that out? Well, it's looking at the gold against bonds ratio, and we can see it kind of in the last week or so, it kind of attempted a breakout there, and it failed. So that's probably going to come back and correct some more, but that ratio breaking above the red line, that's very important for gold. And you can say the same thing with gold against the US dollar. I mean, that failed that resistance. Now it's lost the moving average in the last week, as you can see. So, I mean, that looks like it could come back down in the next couple months and, perhaps make a massive double bottom. And so this is potentially, this isn't technical analysis, by the way. When you see people drawing lines on their charts, I mean, technical analysis is looking at, it's looking objectively at the market, kind of evaluating probabilities and possibilities. It's not drawing lines everywhere. That just really bothers me when people do that and they say that's technical analysis. But if you can see there, this is a weekly chart, but those two moving averages I have there, they're equivalent to the 20-month and 40-month moving averages in gold. And if you look at gold's history going back 45 years, the 40-month moving average is extremely significant, but the 20-month also very significant. And so one of them is in the low 1200s, around nearing 1210. The other one's at about 1230. So, what I'd really like to see as a bull, I'd like to see gold close the month above 1230. In other words, gold rally in the next couple weeks, have a good rally above 1230, but then hold the rally, hold those gains into the next month, forming a bullish reversal on the monthly chart. And so, I think we're probably going to rally, but it remains to be seen if the market is going to be able to hold the rally into the next month. And this is just a rough sketch, but if gold loses 1200, you can look at the chart. There's not a lot of support there. There's some support at 1180, but after 1180 and 1200, the next support is probably 1080. So, we're in the low 1200s. If you look at 1200 minus 10%, that's 1080. So, that's not a huge drop per se, but it would be obviously a big drop for the miners. But if it loses that support, it's going to be increasingly likely that it's probably going to come down and do a round trip. But again, it looks like, this is just a projection. It's subject to change. But this is a possibility. And as I said, if gold loses 1200, I think this possibility becomes more likely. So the bad news is, we could see losses in the coming months, but obviously people would panic. They'd say gold's in a bear market, gold's going to 500, but that would be a lot of nonsense. And looking at the resistance there, that line around 1375 to 1400, if you can do a measured move looking from 1375 to 1050. So if gold went above 1375, you take that $225, add it to 1375. So you'd get an upside target of 1600 potentially. So if gold does come back down and make a double bottom, it could make a fast move to 1600. But even with that being said, let's just remember, I mean, I have a ton of charts that I could have put on here, but I just wanted to keep it all in this one slide. Let's just go back to January and remember how oversold the gold stock sector was. And I mean, maybe the sector doesn't make a double bottom. Maybe it breaks below 1200. Maybe it bottoms at 1100, 1120, and not 1050 or 1080. I mean, I don't know. But the key thing is, if this does happen and we do get a breakdown, not to lose sight of the fact that we just had a really long, bad bear market. I mean, you don't have another long bear market on top of that. As I said, we would probably see a higher low in the sector, maybe a double bottom, and it doesn't mean every stock is going to come down and retrace everything that it gained. I wouldn't expect that to happen. I mean, every stock is in this scenario. There would be clearly downside pressure on the sector, but every company, every stock is different. Some might go all the way back down. Some might not even go down that much. I think the optionality plays, if you follow those in the last week, there was heavy selling there. They're really starting to fall apart. So the optionality plays, I would be wary of those under this scenario. And I'm offering a discount to everybody that's attending. Just send me an email, and I'll give you the discount. And that's all I have. We got a couple minutes left. Thanks so much for attending and listening. I appreciate it. And so, I mean, the next conference is in 6 months. So in January, that's not 6 months. It's only a couple months. I was thinking the next conference was in May. But so just to conclude, as I've already said, the next couple weeks are going to be very important. Each person is different. Some people, they can hold things through huge losses, but if you can't, you need to cut your losses quickly. That's one thing I tell my subscribers. If you buy something and it's already down 10 or 15% and the market looks negative like it does now, I mean, you just have to get rid of it. You can always get back in. But look, as I said, every investor, every trader, they're different. And so they have different risk tolerances, goals, et cetera. But just you have to mentally prepare yourself for the possibility that we could have a rough quarter or two here before things get a lot better and start going up again like we expect. Thanks again.